Hey investors, are you feeling that buzz? US markets are hitting record highs, with indices reaching unprecedented levels. But amidst this surge of excessive optimism, there are crucial deadlines and shifting expectations that could dictate where your money goes next. We're talking about President Trump's tariff deadline, a Federal Reserve that's regained its initiative, and the surprising resilience of the US economy. But the plot thickens. The White House is openly attacking Fed Chairman Jerome Powell, demanding action. What does all of this mean for traditional safe havens like gold and silver? Stick around, because we're about to uncover what's really moving these precious metals and why they might be a smart move in this complex landscape. Next. Let's set the stage with what's dominating the headlines this week. U.S. markets are cautiously awaiting President Trump's next move as his tariff deadline approaches on July 9th. While some trade agreements, such as those with Vietnam, have helped calm investor concerns, agreements with major trading partners like Canada and the European Union remain unclear. This has led to a slight decline in the effective tariff rate from 17.8% in May to 15.8% currently, reflecting market optimism that the White House can continue its negotiating approach and avoid trade shocks. Adding to this positive sentiment, the latest U.S. jobs report for June was a blockbuster. The economy added 147,000 jobs, far exceeding expectations of 106,000, and the unemployment rate surprisingly fell to 4.1% compared to expectations of a rise to 4.3%. This strong data has dramatically shifted expectations for a Federal Reserve interest rate cut. The probability of a cut at the July meeting has plummeted from 24% to just 5%, and even for September, it's down from 94% to 78%. The Fed now has the luxury of time and feels no pressure for an immediate cut in July, amid strong employment figures and rising confidence in the resilience of the U.S. economy. However, in this changing landscape, political pressure is mounting on Federal Reserve Chairman Jerome Powell. The White House continues its public attacks against the perceived dovish policy. On the eve of the jobs figures, President Trump escalated his attacks on Jerome Powell, demanding his immediate resignation, and also attacked the entire Federal Reserve for not cutting interest rates. Furthermore, Treasury Secretary Scott Bessent directly criticized the Fed, stating that interest rates were too high, hinting that pressure on Powell would continue in the coming weeks. Amidst these political attacks, Powell himself remains silent. This period of excessive optimism has seen the S&P 500 hit a record close of 6,279.35 points. But analysts warn that the sustainability of this optimism hinges on companies delivering strong earnings results that exceed expectations in the second quarter. So, while the economic front looks relatively quiet this week, all eyes are on the White House's trade policy developments and the ongoing political pressure on the Fed. But even amidst widespread excessive optimism and shifting political dynamics, smart investors always look to diversify and protect their portfolios from potential trade shocks or unforeseen market volatility. This often brings gold and silver into the spotlight. So let's explore what's been influencing these precious metals. When we talk about gold and silver, several key factors typically influence their prices. Interest rates. Generally, lower interest rates tend to make non-yielding assets like gold and silver more attractive, as the opportunity cost of holding them decreases. Conversely, higher rates, like those the Fed is currently keeping steady despite political pressure, can make them less appealing as alternatives like bonds offer better returns. Inflation expectations. Gold and silver are often seen as a hedge against inflation. If investors expect inflation to rise, the value of fiat currencies might decline, making precious metals more attractive as a store of value. Oxford economics analyst Nancy Van Den Houten noted that strong jobs numbers give the Fed more time to monitor the impact of tariffs on inflation before making decisions. Economic uncertainty and geopolitical risks. During times of economic or political instability, investors often flock to gold and silver as safe haven assets. While the sources highlight current market optimism and reduced recession fears, any sudden trade policy developments or continued political pressure on institutions like the Fed could create uncertainty and impact this. US dollar strength. Gold is typically priced in US dollars, so a weaker dollar makes gold cheaper for international buyers, increasing demand and often its price. A stronger dollar has the opposite effect. Supply and demand. Like any commodity, the mining output, industrial demand, and investor demand for jewelry, coins, ETFs, etc., play a significant role in price fluctuations. So, given these factors, why might an individual consider buying gold and/or silver right now, especially with the backdrop of the current market? As a hedge against inflation, with inflation data being a crucial monitoring point for the Fed, gold and silver offer a historical record of preserving purchasing power during periods of rising prices. Safe haven during uncertainty. Despite current market highs and excessive optimism, the sources remind us that the July 9th deadline for tariffs could still send markets back into volatility. Gold and silver act as a store of value during times of economic or geopolitical instability, offering a potential counterbalance to stock market downturns, especially when there's unprecedented political escalation targeting central bank independence. Portfolio diversification. Adding precious metals can diversify an investment portfolio, reducing overall risk by including assets that may perform differently than stocks or bonds, especially when there's excessive optimism in the stock market. Store of value. For centuries, gold and silver have been recognized as a stable store of wealth, resistant to the devaluing effects that can sometimes impact fiat currencies. In conclusion, the current investment landscape is a complex mix of high optimism driven by strong economic data, underlying uncertainties like trade policy, and significant political pressure on the Federal Reserve. While our sources highlight a return to excessive optimism, investors are advised to be more cautious and selective in their investment decisions. Whether you're tracking the polls of numbers and politicians' tweets or looking at alternative assets, staying informed is paramount. If you found this discussion helpful, please like this video, subscribe to our channel, and hit that notification bell so you don't miss our next breakdown.